When the value of the shares that you hold in a business is going down rather than up, it's natural to consider whether it's worthwhile continuing to invest. But although the figures in the stock chart will indicate a trend, they can't tell whether the underperformance is a result of a temporary issue or something more serious. If you want a more reliable forecast, you need to discover what's going on at the company. And there's no better way to do that than to attend their AGM and to ask some searching questions. That's exactly what Mark will be talking about today on episode 5 of The Desert Island Investor. Okay, good afternoon, Mark. You've been absent again. Where to this time?
Yeah, happy new tax year, Paul, first and foremost. I've been off to a place in Suffolk called Hira, and that is where I've attended the Titon Holdings AGM, Hira in Suffolk. So this is a company that's involved in natural and mechanical ventilation, and it's the smallest business in which I'm invested in. It's got a market capitalization of just 8.3 million. So it's a smaller business, but it's one that I like to keep a close as opposed to a closed eye on.
Okay, so what exactly do Titon Holdings do?
Well, like I said, mechanical. They started off doing natural ventilation, but they've been doing mechanical ventilation, I think, for nearly 20 years now. And it's an increasingly important attribute into the household because it's probably something that we just took for granted. Natural ventilation, Paul, when we were children and we were growing up, and you had rattling sash windows and what have you, and leaky houses, and homes tended to ventilate themselves. So now, over progressive decades, the need to insulate is becoming greater. So we're almost like hermetically sealing these homes so that the heat doesn't escape, but it means that fresh air can't get in. So we've got to get another means of helping our homes to breathe, because otherwise it'd be like living on a submarine. So it's that's basically the need for ventilation.
So that market has changed by virtue of progress and development in house construction and double glazing and triple glazing and such lights. Yeah,
all those. And there's a lot of health concerns that are associated with ventilation. We hear now it seems to be like increasing case of asthma and that are around, and homes can be. We tend to think that we're shutting out things. The air outside is more dangerous to us. Well, very often it's the air in the house that's of most cause to us, because we produce, humans and pets, we're producing a lot of fluid, a lot of moisture, and if that can't escape, that creates mold. I don't know if you've got any mold over in where you live, Paul, but that's
only my fridge, Mark. Yeah. I've got a bit of mold in the fridge.
Okay, let's not go there. But that creates spores, and that's not good for breathing. Then you got things like cigarettes and e-cigs and scented candles, sprays and aerosols, and then there's things called VOCs, volatile organic compounds.
Oh, I've heard of that.
Things like formaldehyde come under that. I think a lot of that. It's in a lot of furniture. When you get a new 3-piece suite or something like that, and it's giving off a new smell and all these smell. So these things are all around us in the home, and then they need to escape. Even down to things like if you've been doing some painting and decorating, Paul. So if you've got a house that's airtight, it's not very good. And we've just come through the pandemic, haven't we? Everything seems to come back to COVID-19. And one thing that we found out there is the importance of fresh air. What did they tell us? What would the government tell us? Open the window. So now you might think that's the easy way, just to ventilate your home. But of course, I live in a semi-rural area. If you're opening your windows and you've got noisy neighbours or traffic rattling past or stuff like that, that's not always the answer. So increasingly, ventilation, people are becoming more aware of the need for better ventilated homes.
And of course, in businesses as well, I suppose, you can't often open a window in an office, can you?
No, and we just find out how stuffy it gets in an office, Paul. I mean, we used to work together, and during the middle of the afternoon, you saw me nodding off. That was probably down to the the poor air circulation in the office.
Yeah, I would often wake up and see that you were asleep as well. Yes, that's
yeah. That's our excuse, and we're sticking to it.
Okay, so can you give me a little history about the company?
Yeah, well, it was formed back in 1972 by John Anderson, who's the current president of the company, and he showed some foresight because in 1973 he painted a handmade trim vent, which is a natural trickle vent, still the same kind of thing that they manufacture today. It was floated on the London Stock Exchange in 1988. Then they moved into mechanical ventilation in 2005. They formed a US subsidiary, which is a small part of the business, in 1990. And in 2008, they entered into a joint venture in South Korea, which has been quite good for them. It's been it's a reasonable size of the business. And then they transferred the listing to AIM in 2018. So that's just a pocket history. I'm sure if you go to a website, you'll find a lot more of events that have happened. But those are, some of the main ones over the last 50 years. And they just had their 50th anniversary last year.
How long have you been an investor?
I've been an investor since late 2017, and I have added several times since then. And I've done a lot of hard work, a lot of diligence. I've done a lot of research, and at the end of that, I'm underwater by nearly 40%. So I'll come clean on that one.
Okay, so that being the case, what was your initial investment case?
Well, really, was it a value trap? I was looking at the valuation of the company, and it had lots of cash, which I like, and lots of assets. But, again, so that gave me what I thought was a certain amount of protection. But I think it's the increasing awareness of ventilation. And, what we just spoken about, that this is going to become a more important requirement in UK housing construction. Even down to, it's going back a few years again, but like Grenfell came along. That's another thing that has affected, how we look about how we construct homes, and Titon themselves produce a metallic air brick, a fire brick. So, you don't want, if it's made out of something like plastic, that's not very good in the case of a fire. So that's been a good seller for them. And going back into, they've been there was some new legislation that's been coming along for quite a while. That's finally in place now. That took effect on the 15th of June of last year, 2022. So that was at the back end of the last financial year. So there's just a few weeks of that. But basically, new homes are going to have to be equipped with sufficient natural and mechanical ventilation, plus, interestingly or importantly, replacement windows needed to be fit with natural ventilation, Paul. So I've had words with several double glazers, and there's certain tricks going around where people, they've been saying, people say, well, I don't really want the trickle vent, but well, you have to sign a disclaimer that you don't want one. So, but I think that the pressure will be on, certainly, to any replacement windows will have to have trickle vents. And one thing about new builds, they go up and down, but there's a lot of existing windows out there, Paul, that they're going to be maturing. What's the life expectancy? 20, 25 years. So there's a lot of windows out there every year that'll be getting replaced. I would imagine that's going to be more consistent than the number of new builds. So that's what lured me in, Paul.
Now then, so well done with all that research, but net result is you're sitting on a loss at the moment. So yeah. How are you coping with that?
Yeah, fine, Paul. It's I think when you've got a broad portfolio, these are things that you accept. Obviously, you'd like every decision to be a winner, and it might be in the long term. But I'm comfortable with my position, and that at the start of any one year, generally you're going to get some winners, some good ones. Some are going to tread water, and there's one or two that might not do too well. The problem is you don't know which ones they are. And very often you'll find a lot of very successful investors, not necessarily putting myself in that category, have something like a 50-50 or a 60-40 rule, or not 60-40 rule, but sorry, 60-40 effect. I've listened to a very well-respected investor called Leon Boros. A lot of people have heard of him, and he said he's consistently at 60-40. He doesn't seem to be able to improve on that. So it's part of I won't say the game. I don't like to call it a game, but it's part of what you sign up to when you're a private investor. That from time to time things will turn poor for you, or you may underperform for certain periods.
So the concept of this episode, it kind of revolves around the fact that if there's questions to be asked about a company that you've invested in that isn't doing particularly well at any one particular time, is to try and get along to an AGM and have a chat with them. So you went. What went wrong?
Well, I think what's gone wrong, just rewinding a little bit, Paul, is that this is a business. This is an industry that I think's got a very, very good tailwind, but it seems to have been beset with problems over that time. I'm just waiting for a bit of a clear run. So some recent events. A couple of years ago, the CEO, who'd been with the company for 33 years, he agreed with the board to stand down. And they appointed a new CEO, Matt Norris, who was a younger man, seemed to have lots of energy, and he had a good CV. But following that, two of the non-executives left. I think I understand that was that they were acting in unison, really, which isn't great for non-execs. They left together. I think that probably spooked Matt a little bit. He was new to the company, or I think a new opportunity came along, so he left in short measure. Then there was another director left, IT director again of 33 years service. He agreed to stand down. And then what we had over that, the last couple of years, 2 or 3 years, they've had Brexit to contend with. That's been a jolt. COVID that we've mentioned, it affects everything. Labour shortages. They're in quite a rural area, so they're not inundated with high populations around there. Component shortage that's been well documented. Those are important for the mechanical ventilation. And then general raw material problems like packaging and just resin and things like that. Just your basic raw materials, energy prices, inflation, and then the Korean market that's been very, very successful for them, which has been natural ventilation. They've been moving over to mechanical ventilation, and they don't manufacture on the mechanical side out there. It's just natural. So it's just been a little bit of a catalogue of things that have been outside of the companies. To be fair to them, these are things that have been out of their control. Other than let's put the whatever that might have happened in the boardroom to one side, but they can only control the controllables.
And where was this then? Was it at the company headquarters?
The headquarters, the offices are in Colchester. And we'll perhaps get onto this a little bit later on. But the manufacturing facility is at Haverhill, which is, and they're 30 miles apart.
Right, okay. And a lot of people there?
All the board were there with the exception of John Anderson, who unfortunately was a little bit poorly that day. So it was good to see all our directors, including several that I was meeting for the first time. The new CEO, Alexandra French, who joined from Johnson Matthey, and the new execs, Paul Hooper, who had a good chat with Paul. He's the CEO of Alimask, which I'll have to have a closer look at. And Jeff Ward, who's the CEO of Guardian Fall, who are a height safety company. But on the shareholder side, I think there were 6 of us there. So
6.
Yeah. So not surprising.
And questions. You are notorious for asking questions at AGMs, Mark, I believe. So anything interesting that you raised at this one?
Well, I did ask about a dozen, and intended to get my money's worth because I was down there for a couple of days. So I asked about a dozen questions, which I've got to say were very well received and answered thoroughly across the team. It wasn't just that, one person was answering them, and I think they tried to answer them as fully as they could. And the first one that I brought up was, I've just gone on about the problems that the business has had in that are outside of its control. But they brought in a new ERP system. All have to be 3-letter acronyms, Paul, don't they? Enterprise Resource Planning System. And this has caused, if you read the report, it's caused significant problems putting in a new system. And I asked the question, well, this was something surely that we could have had control of, given that everything else, that we've had to contend with, we should have been over this like a rash. And they accepted that, it could have been perhaps handled better, but I'm sure you're familiar with this, and I tend to agree that when you do bring in a new computer system or a new system across the group, there is collateral damage, isn't there? There's some damage it's damage limitation. So, I do accept that. I think it was worthy of comment, but I think the answer I've got it was never a good time, but we've got to pull the plaster off, throw the big switch, and we've got to do it sooner or later. So let's get it done. And the message that I got back was that the bad medicine's out the way now, so they will start feeling the benefits of it, and that'll mean that they have the different departments and the way that the workflow, it's more tied up, and they've got more visibility of everything that they've got, like inventory and what have you, and where everything is in the business. So that was that. I asked a question, a personnel question really, which 2 questions in one. This one was about the opportunity, what's the prospects for greater automation in the business. And this is, I explained, this is me as not a shareholder looking to see for staff being replaced, but they keep talking about the problems that they've got in recruitment. And I say that we need some kind of automation to replace the people we can't get. That was basically what it is. And they've got a new operations director coming in, and he's looking at ways in which they can mechanise or automise the way they do things and help throughput. I think it's something that they are aware of, that they've got this ongoing problem. I mean, I stayed in Newmarket, which is about 15 miles north of Haverhill, and I drove down and I said, look, I'm going through all these lovely leafy villages, where you might meet Miss Marple. There's not a lot of people there. That's the thing. It's not there like in the northwest where we are, Paul. It's where there's and it's a low wage, a low wage economy. So that's the problem they got. But on the personnel, I said, look, are you doing anything? Just we're blank looking at every employee that you've got in the business, and they've got a couple of hundred employees with a blank sheet of paper. Have you gone through the exercise of seeing if everybody's reaching their full potential? And I mean everybody. Because I think I've lost count of the number of people that I've come across in my working life who've started in the warehouse and they've ended up as managing director. And we both know people that we work with, Paul, who've gone on to, better things. So, the answer to that was that, every employee is having a development plan to see, what where they're doing. They're very keen on apprenticeships, and they did trot out a couple of examples of people who've advanced within in the business. So it's not just about looking for business. It's not just always looking outside of the company, because you've got some talent within the business, haven't you? Very often that we overlook people within our organisation. Then, we mentioned about the Colchester office. So I previously asked this question about, I've said, look, it's not it's not a big business, but you've got a headquarters in Colchester and then the manufacturing Haverhill. Does it not make sense? There's a lot of duplicate additional costs there of running an office. And, the answer has always come back. I asked about this a couple of times, and I do understand it, that if they said to everybody in Colchester, look, we're moving to Haverhill, then the fear is there'd be a mass exodus. Because, again, it's out in the sticks. It's 30 miles. It's adding a lot of commuter time on. Commuter time. It's adding a lot of commuter time on. So I accept that. I think those offices are on a 5-year lease. I think it's something that they do review. But when I read in the report, it was saying again that like a lot of other businesses, they are allowing certain members of staff to work from home 2 days a week. And I think that is because lots of other people are doing that now, and that's what you've got to offer. So I revisited this question, and I said, look, I think it's fair to ask this now. If we've got an office in Colchester and people aren't there 5 days a week, does that swing things back to, moving it to Haverhill? And it was still felt that even if people were, not everybody's in the office 3 days a week, depending on what duties they have, but even at 3 days a week, it would still be prohibitive for people to move to Haverhill. But they would review it. So as long as it's still there, it might. It's probably the right answer to give. That we need to give this. But I thought it was something I would explore. Titon used to sell a range of products manufactured by a company called Subinco, and they decided last year that they were going to do their own thing, going to deal directly. So that was pulled. So I asked the question, what level of business did this represent? And Tyson Anderson told me that there was about between 10 and 15% of hardware sales. But they brought on a new range of products called Roto, and they're trying to build these sales up now. And this is to replace the Subinco sales, but this is he estimated that's going to be about 50% of what Subinco had offered. But there's further potential there. There was a reference into the report to restructuring the Korean side of the business. So I asked, well, what does that mean? Is it the fact that in Korea they're moving more onto mechanical from natural ventilation, so they're having to buy in mechanical ventilation? Is this perhaps a euphemism for parting with the side of the business? And said no, very much so. No, very much. We see this as a future for the business. They're into ventilation, so are we. But I think it was simplifying the structure, whereby the two aspects to it. There's Titan Korea, which is the manufacturing arm, which has got Titan UK of 51% ownership, and then there's a distribution arm as well called Brown Tech, which distributes whatever's basically manufactured from Titan Korea, and they have a 49% ownership in that. So I think what they're looking at is to make it just one entity, a little bit more simple. I asked about the components. Are we back to normal? No, but we're heading in the right direction. I think we're gradually clawing our way back now to getting components. And this is the kind of feedback I've been getting from other businesses which I'm involved in, that it's getting easier to get hold of components. And then with on the cash situation, I looked at the number of creditor days and debtor days. Cash was, I think it was £1.7 million worth of cash on the books, but I'm using we were paying people quicker, which I think is an honourable thing to do. The previous year we've been paying people on 62 days and we're paying them on 52 days, but at the same time, debtor days had gone out from 50 to 58. So that was like an 18-day swing. So that will have an effect on cash. And the answer that I got back was, and it's pleasant to hear that, they're trying to get better deals by paying quickly, which it makes sense, Paul, doesn't it? It's very difficult to get a better price if you're holding back on paying people. And I've always been An admirer of companies that pay promptly or early. But as well, on the debtor days, I think that had been exacerbated by stockouts and what have you. And my interpretation of this, or my understanding was this, is of sometimes people are prompted to pay you when because they might go on the stop list. So if you can't supply them with product, it doesn't matter if they're on the stop list or not. So I think that's something that, now that they've got more, product available, then hopefully that will help the money get in. And then I asked a question. I mean, when you look at this business, it's, I mentioned about it's the capitalization currently as we sit here today, Paul, of 8.3 million, and it's got assets of 16. So that's quite a discount. But they've got freehold property, and I asked, that's on the books at 1.7 million, and I asked, when was that last valued? It was quite interesting that that was done at the year end, and that was valued at 5.4 million. So that's an extra 3.7 million. So that was an interesting fact that came out from the AGM, Paul, just asking that question. And then, I asked some other questions, but I parted with a couple of comments, really, a little bit of feedback. One was on the RNS Times, which I give us several examples whereby results have been due or certain announcements. And generally these come out at 7 o'clock in the morning. And I think there've been one that come out at 11 minutes past 7. And there've been other ones that they've been released, throughout the day. And I just explained that that's a tendency to spook investors.
Can I interrupt you there?
Yeah.
What's an RNS? Sorry, not an investor.
An RNS is a regulatory news service. So that's, any important issues pertaining to the company. It could be results, director dealing, major holders, resignations. That's announced as an RNS on the stock market, and they can come out during the day. But generally, if it's an announcement if it's something that's scheduled, generally they come out at 7 o'clock, and that's when people are waiting for them. So if they're being trotted out during the day, that spooks people. People think, why are they holding back on this information? And I just think that's a little bit of a red flag. I just think that is something that's quite simple to rectify. It's just a little bit of, I think, better housekeeping. So yeah, that was a little bit of feedback. And lastly, it was, I pointed out that, and I believe in speaking honestly and openly, it was on the director holdings, and the directors and their families, I believe, own about 40% of the business, but a lot of those are family from the original Anderson family. So I pointed out to that Alexandra, who been with the company, admittedly, under a year, but she like 12,738 shares. And then I turned to Carolyn, who's the CFO. I said, you've been with the company since 2019. You haven't got any. And then I turned to Jeff Ward, one of the new non-execs, and he didn't have any either. So I pointed out, look, you're all very clever people. You've got probably cleverer than I am, and you've got a closer understanding of what's happening with this business. I said, I'll take my lead from you guys. So, and I think that was taken. I said I come as a friend, and it was taken with good grace. It's. I think it was worthy to be said. I'm looking at, if you don't think there's compelling value in this business, then why should I? That's the question, Paul. And and I always say, Paul, it's not what you say, it's how you say it. I stressed, and they know where I was coming from, that this is something that private investors look at. Like I said, on the wider board, there is a significant holding, but if you look at the the CEO and CFO, those are in the highest executive office, aren't they? And you can speak. You can raise concerns without it being antagonistic. I mean, we worked together, Paul, for nearly 10 years, and for the most part, we were very, very well. But you were in marketing, and I was in sales. But occasionally we'd have differences of opinion, but we never let it get personal, did we? Fish face.
Absolutely not. Baldy.
Yeah. So. Yeah, and then there was some, so I think I'd probably stolen the thunder of the other shareholders there a little bit. I'd done a lot of the heavy lifting, but David Barry was there. He was a shareholder of note. He owns over 3%, and he's a well-known investor, clever chap. And I'd met him previously up at the Zytronic AGM, so we met up again and had a little bit of a conversation. But he asked questions about whether they were committed to the listing. The way he asked it was, for a small company, is it expensive listing? Is it prohibitive? And they said no, relative. It doesn't cost that much on AIM. So that led him into saying, well, are you committed to the listing? And very much, they said that they were. The answer that Keith came back. Well, obviously. We're looking to grow the business. That's what we're looking to do. I mean, he did mention to David again in front of the non-execs. Well, presumably if he went private, you wouldn't need the non-execs, would you? So that created a little bit of a giggle. But again, he made a valid point, and he wants to see the response from the board as to the feedback that they've got on the. On their listing on AIM. And then I met another investor called David Raywood, who come from Tewkesbury, and he asked a question about the solar the solar panels and that they've got, because it's quite a large facility that they've got there, and how effective they were and what have you. And met David. He'd come by he'd become by public transport, and I gave him a lift back to the station. So I met a new friend there, Paul. Another new investor.
So do you actually get a tour?
Yes, yeah. It was a very good tour. Again, we were taken around by Alexandra, which was a nice touch. The CEO, and Paul Tarling, who's the relatively new director of operations. So he's feeling his way as well. But it was good to see. I think from memory, your memory plays tricks on you, but quite a bit more product seemed to be like going out, particularly on the mechanical side. So, and that's there's more money involved on those big mechanical boxes than on the smaller trickle vents. So that was good to see.
Now, I believe there's been a couple of post-AGM
yeah,
as well.
Well, there we go. Yeah, so you go to the annual general meeting. You try and find out what's the state of play and how best can I understand what's going on. I've come away. I've met the new CEO. She seems to be quite dynamic. She's in her mid-40s. Seems to have plenty in the tank. But then there's an announcement that she's agreed with the board to stand down. So this is like you think, well. I've just 2 weeks prior, and I've spent 2 nights in the area. I've gone down there. I've met the new CEO. Everybody seems to be, on message. I've asked comprehensive questions. I feel like I've got an idea about where the business is, and then something like this happens. So, thinking, well, what's happened here? And we've got to remember that this is the third CEO in 2 years. So, this is a listed company. It's not a Premiership football team. So, you're thinking, what's gone on. So I made contact with Keith Ritchie, who's the chairman, and said, look, I wonder if you can help me. I explained that obviously I've come down, and again, just repeating, I thought I'd gone away and understanding what the state of play is. Can we have a telephone conversation? So, to be fair to Keith, he agreed. And my relationship with Keith is, I like to think, very strong. When the results are announced, we always have conversation. He and I, we have a Zoom call, just the two of us. I have a little bit of a chat. That's at the half year and the full year, and he's been very, very helpful. With how the business is going. But he did telephone me from he was on holiday, but he did nevertheless ring me, and we had a bit of a chat. And he had to pick his words carefully. But my interpretation is, it wasn't about like the goals, what the direction of the company, anything like that, or the direction. I think everyone wanted to go in the right direction, the same direction, but it was a case of management style as much as anything, and it just wasn't. It was felt that that wasn't going to work. So they're going to be looking again. Now, don't get me wrong. I think Alexander is a very, very talented, from what I've seen. Got a great CV. And I'm pretty sure, remember the name, because I'm pretty sure she'll crop up somewhere else in a top role. But she's come from Johnson Matthey. She's been there for 25 years, or just short of 25 years. Johnson Matthey is a company valued at 3.6 billion, right? Titon is 8. So there might be a bit of a culture change there, Paul. That's difficult, but businesses are, the basics of businesses are the same, but it is a much, and this is just my interpretation. This isn't what Keith said. It's just my understanding. Perhaps it's difficult to adapt, and sometimes, Paul, people just they aren't the right fit. That's what it is. Some people just aren't the right fit for a certain business. So, and I suppose from Titan's point of view, it was a brave move in that. Like I said. They've had three CEOs in short measure. They wouldn't have done this, I don't think, lightly unless they thought that it had to be done. Because I'm sure they would have been desperate for this to work. But it just goes to show, Paul, isn't it? The interviewing process. You're trying to find out if people are the right fit, and you do several interviews and various testing and what have you, but it's only over a long period of time that you can really find out, can't you? You can be married to somebody for 10 years to find out what they're really like.
Well, people are trained. Students are trained to interview well. But it doesn't necessarily mean that they are going to be what they appear to be in the interview. That often works out to be the case, I'm sure.
Well, it's a bit of a scorpion dance, isn't it? You've got to, we all know there's like, you got to smile when you go in, haven't you, and say things like, I'm ambitious and things like that, and I like a challenge, and I'm a team player, but I can still, I like working on my own, and it's all the usual kind of stuff.
It's all about body language and where do you see yourself in the next 5 years, and this kind of stuff.
Yeah. I didn't used to do quite well on that one. Well, retired hopefully. Yeah. So, so that was. Full credit to Keith. We had a chat, and it's hopefully they can get this resolved. So I don't know who's going to come in next. And it's important that they get it right. I don't know who it's going to be. The hot money's on either Sam Allardyce or Roy Hodgson, Paul. That's it. But I think they do know that they've got to. I'm saying the obvious thing. They've got to get this right. Now on the heels of this, there's been a change in some of the shareholding, in that Rockwood Strategic, who are an investment trust, have now got over 20% holding in the company. Now, I'd long thought that Titan might be. Now, Rockwood Strategic are part of the Harwood Capital stable. And I thought that Harwood, this might be a business that Harwood might be interested in, and I've been proved right. And they took a stake, I think an 8.74% stake in June 2022, so that's quite recent. I think they took over the holding that was previously held by MI Sterling Select Companies Fund, and then they've taken on the 11.27% that was held by Jupiter Fund Management. So they're now over 20%. And I'm not sure it's the first time that John Anderson is no longer the leading shareholder in the business. So, yeah, they've got, over 20%. And it's headed by Richard Staveley. This investment trust is headed by Richard Staveley and Nicholas Mills. So you can have a look at Rockwood Strategic as well. It's got a ticker symbol RKW. And quite interestingly, they've got a very concentrated fund. They've just got 18 holdings. And the thing that strikes me is that they've got a very, very hands-on approach. They on their website, they say that Rockwood Strategic PLC is an investment trust quoted on the London Stock Exchange that invests in a focused portfolio of smaller UK public companies. The strategy identifies undervalued shares where the potential exists to improve returns and where the company is benefiting or will benefit from operational, strategic, or management changes. These unlock, create, or realise shareholder value for investors. So that's that. Now, what you also find, if you look on the Rockwood Strategic website, is that Richard Staveley is a non-executive of three of their holdings as well: Bonhill, Centaur Media, and Pressure Technologies. And another couple of items that they put on, another couple of articles that they've got, or pieces. It says, for larger core holdings, the company will seek to acquire influential block stakes targeting between 5 and 25%. Well, now Titan fall into that category. And they say of how they unlock value. They say, for core investments, we ourselves may be the catalyst through the provision of capital, insight, and personnel. So having read that, Paul, I don't think they'll be frightened to pick up the phone and have a very much a hands-on approach. And my thoughts would be, I have no inside knowledge, but they'd have some kind of viewpoint on any new directors that are joining the business. So hopefully it's a good team to have on board.
Okay, so in total then for Titan, excellent products, opportunities are favourable. Figures aren't great at the moment, but based on the information you obtained by attending the AGM, are you sticking with them for now?
Yeah, I mean, they made a loss last year of £953,000 before tax. They're expected to make a loss in the first half, return to profitability in the second. I think, given, again, the tailwind of what's happening with ventilation, and the fact that there's hopefully the protection of the discount to the net asset value, and you can be in a discount for a long period of time. But that gives me a little bit of comfort. Plus, Rockwood see some value there, so I'm in for the course. And it's just obviously I want it to do well, Paul, because I'm an investor and I've got money involved, skin in the game. But I think it's in a worthy cause, Paul. I do think something like, it's I'm not investing in British American tobacco or something like that. It's improving the health of homeowners. So I think it's a worthy cause, and I really would like it to do well for that alone.
So based on the initial concept again of this episode, which is there's more to it than just a graph, isn't it? For the end of the day, for investors.
Yeah, there is the story. If you're just looking at data, then that doesn't tell you everything, Paul, does it? It's all historical. You can learn a lot more through going to the AGM, but even that is not perfect. You go to you're trying to read body language as best we can. You're trying to pick up signals. There was nothing forthcoming, and you and I, Paul, we know that, we all know that dream couple, don't we, that go to the dinner party, Brendan and Sylvia, and everybody thinks they're great. They're hanging on every word. He's very attentive and whatever. She looks fantastic, and then you find out that they're getting divorced. So no matter how much you try and pick up on things, you don't really know what happens, behind the scenes. So
no, true.
But again, if you if you can make the time to go, if it's cost effective to go,
yeah,
I think, and you create relationships. You know, I've had an exchange of emails with 4 of the directors subsequent to the AGM. You know, just exchanging pleasantries or what have you. You know, so hopefully you're developing a relationship with those people.
Okay, so Titon Holdings, hopefully a change in the weather coming their way soon. Is there a website that people can go and look at?
Yeah, always look at the website, Paul, allthews.titon.com.
And their ticker symbol is?
TON.
Right, it's time for our regular question in a bottle spot. Let's see what's in the bottle today. And this is a question from Declan. And Declan asks, Mark, what is the PE ratio?
Right, Declan. Well, thank you for the question, and thank you for your kind words over our previous podcast. Appreciate your support. So, just in case we've got some experienced investors out there who are groaning that we're covering something like the PE ratio, when Paul and I first started doing the podcast, we explained that we were looking to cater for both experienced investors and people who were new to investing or novices, a bit like Paul himself. So, when we talk about the PE ratio, basically what it is the share price of the share divided by the annual earnings per share over the course of the previous year, if we're looking at historic PE. So just to give you some round numbers, if a share was trading at £2.40 and the earnings per share were 20 pence, that will put it on a PE of 12. So what this is telling us is how long it would take us to earn your initial investment back. So in the case of that business, it would be 12 years. So it's an important metric, but not one that should be taken in isolation. What it does do, it enables you to compare it against other businesses and other industries. So you can compare apples with apples or apples with oranges. So supposing we're looking at a supermarket group, say Tesco, something like that, we could look at its PE and we could compare that with say Sainsbury's. But we could also compare that against other industries where we think we can see value. It might be a software business, it might be an oil company. So when we talk about PE, I'm going to be talking here really about historic PE, but there's also forward PE. So if it's something that you're going to be depending on, relying on as a metric, I would suggest that you know which one that you're looking at. If you've not calculated it out yourself, if you're just relying on some information that's given you, what are they basing their PE ratio on? So companies got different PEs. So if you've got a company with a PE of say 10, is that better than a company that's got a PE of 15 or 20 or 30? Well, the answer is it depends. And it depends on the future prospects of the business, not just a case of next year, but perhaps a number of years into the future. If we look at forward PE, that's just looking again just at a single year, or the PEG ratio, which perhaps go into on another podcast. I mean, we could spend forever talking about PEs and PEGs and valuations, but it's you got to understand that behind all the data, all the numbers, there's a living, breathing business that's behind these. If you've got a loss-making business, that hasn't got a PE, so that's where the calculation falls apart. But the fortunes of that business could be very, very favourable, even though it's making a loss at the current moment in time. So what you've got to understand is that some businesses are growing, sometimes very aggressively, and they deserve a premium. Others, in comparison, they're stagnating, and some others are going backwards. And I tend to think that most businesses are cyclical in some way, but some are more cyclical than others. They're heavily cyclical. Look at something like house builders. So, you've got to be factoring in the information behind the raw data about what's happening with that business. So if you've got a software company and that's, say, it's got a PE of 30, and you compare that with a gold miner at 8, you might think, which is the better value there? Well, you might think immediately it's the gold miner, but you've got to look behind the business. If the life of mine is 6 years and it's PE of 8, you're going to struggle to get your money back anyway. So that's just a very kind of basic example, because obviously the resource is being depleted over that period of time. So it's a strange ratio in many ways, in that there's two ingredients, and one of which is the value, the price. That's the P in the PE. That's the share price, and that's moving every day, or throughout the day. It could be every second if it's a highly liquid stock. So that's moving around all over the place. And the E, the earnings, is the annual earnings per share, which is that's a static number for that year's earnings. So we're comparing with a constantly moving figure, and divided by one that gets updated, quite rarely. So we're actually looking in the rear view mirror and at the earnings, and as we're driving along, this is constantly, it seems to be going like further into the distance, and it's not telling us where the business is now. So if we look at the annual report, from the very moment it's published, it's out of date. It's a historical document, and it's giving the earnings per share. And the problem is that there's no profile to that. All the earnings are lumped together, and there's no trajectory. And you might think that the earnings are in a straight line, but they can be quite lumpy. Probably the best we've got is to compare half one with half two and half two with half one. So, for the sake of argument, if we look at a business and say that its financial year end is the 31st of December, it can be several months before the annual report comes out. So, and businesses have got up to 6 months to report. So, by the time the report comes out, say on the 30th of June, we're looking backwards at a business that reported on the 31st of December. And that includes data that was from the 1st of January. So this is nearly 18 months out of date. But if we look at the figures, and we might look at the earnings per share and think they look fine, but because they're grouped together, it can disguise some information. We don't really know the profile of the earnings. So things might have been going along quite well, and then we get to November, and then there's a little bit of a wobble in the business. We get into the new year, and things are getting progressively worse, and then that develops into a tailspin. By the time we get to June, where we're getting the previous year's annual report, the reflection of the business, what the state of the actual business is in, could be totally different. So you've got to be looking at, as best you can, reading in what's happening to the business. So it's important that we look at that. It's a numbers game, but we can't rely too heavily on the numbers. There's always a story behind the business, and there's management, and there's people, and you can look at all kinds of metrics that you could put in, and people have filtering systems, and I think that can only just improve your chances. I don't know anybody who's found a system that's totally foolproof. And if it was just a case of putting data into a computer, then I think everybody would be doing it. I mean, there's certain things like the Piotrowski score, and that text 9 criteria. But again, all these can do is improve your chances. So I would say, look at the data and interpret it, and you've got to understand that behind every number, every statistic, every ticker, there's a living, breathing, organic business behind it.
Well, that's all for this episode. We hope that you enjoyed it. Please remember the content is for information only and it is not financial advice. If you would like to pop a question into a bottle for Mark, just post your question in the comments and hopefully it'll reach the island in time for the next episode. Thanks again for listening. See you next time.